Oh boy, this is going to be so much fun because we begin our long march, our investigation into the world of stocks. Exciting stocks, sexy stocks, risky stocks. Businesses, I think, is a better term, don't you? Oh well. We start with a quote from Will Rogers, a humorist from the earlier part of the 20th century. Don't gamble, take all your savings and buy some good stock and hold it till it goes up. And if it don't go up, don't buy it. Very wise advice. Well, Will Rogers and his generation knew all too well how dangerous stocks were because they lived through the Great Depression and saw the stock market fall almost 90%. Ouch. Slide number 2. What are stocks? Well, we've dabbled a little bit in the world of stocks. Certainly, we've talked about them when we discussed mutual funds. They represent ownership in a corporation. The legal term is common stocks, and where does that come from? It's unfortunate because people think, oh, I don't want just common stocks. I want preferred stocks. Well, no, you don't. You want common stocks. The term came from the fact that the investors were shareholders in common. Every person who had one share had one vote and had that much say in the corporation. And if you had 10 shares, you had 10 votes. 100 shares, you have 100 votes. That was the idea behind common stocks. We say that stocks are equity financing, right? Equities is the term we use because it means ownership. Equities is another word for ownership. Stocks enable investors to participate in the profits and growth generated by the business enterprise. But stockholders are limited liability owners, which means you can only lose what you've invested. Whereas a sole proprietor or a partnership, when you take Business 120, Introduction to Business, or Business Law 140, you'll learn about legal structures of businesses. And if you're a sole proprietor, you're on the hook for all the debts that the business incurs. Whereas if you're an investor in a corporation, you are only on the hook for what you've invested. So you bought one share at $100 and it goes to zero, that's all you can lose. Now, there are some unscrupulous individuals who try to use corporations as a way to hide behind debts, and some of them actually became president. One of them became president. But there are ways for the courts to pierce the corporate veil, and we'll leave that for your business law class. Why invest in stocks? Well, stockholders receive optional payments of earnings called dividends. And if the company does well, the products and their services and their markets expand, we should see the value of the corporation rise, and likewise the value of your investment, your stocks, should rise. Capital gains, capital appreciation. But we can also have capital losses when things don't work out the way we wanted them to. Contrary to what many believe and how many people behave, stocks are not simply millions upon millions of worthless pieces of paper, now electronic bits, no paper involved, that people trade every day. No, they represent ownership in a real business, a bona fide, ongoing enterprise. You like those words? You can use them. Historically, what have stocks returned? Well, we like to start measuring back in 1910, 1920, and there's some historical reasons for that we won't get into. But over the long term of modern finance, the return from the stock market as measured by the S&P 500 has averaged approximately 10, 11% for the last 90 years or so. But in any one year, right, it is unlikely the return will be 10 or 11%, as we discussed in Chapter 1. That's because of the variance, the deviation. The return has varied from a high of almost 54% in the 1950s to a low of negative 43.4%. And 2008 return was one of the worst at almost minus 40%. And in any given year, there's been about a 1 in 3 or 1 in 4 chance of a down market. Now, it doesn't work, 1, 2, 3 down, 1, 2, 3 down. It doesn't work that way. 1, 2, 3 up, and then 1 down. It just, for example, 1982 to 2000, 1990, actually 1999, the market went in two directions, up and way up. And then stocks went down 3 years in a row. So you just don't know. As we discussed in chapter 1, we know we have a probability of where it's going to go, and we know what the long-term average is. But what's going to happen next year? I don't know. I don't think anybody else does. You can have a very good guess, and you might even be right. And when you're wrong, you can explain why you were wrong that time, and the next time you're going to be right. Let's take a look at the graph that we saw back in chapter 1. And it shows that with $1 invested back in 1928, according to the New York University Stern School of Business, we did pretty darn well in stocks. This is a logarithmic scale, which should give us pause. We have to be careful whenever we use logarithms. But essentially, we're saying, hey, this would normally be an exponential curve, meaning we go way up in the air, but by using a logarithmic scale, we make it look like a straight line. It's not a straight line. Logarithmically it is, but these little downturns, they're not little downturns. They're big downturns. But still, as long as we've had a long-term perspective, we see that stocks have clobbered loans, bonds, treasury bills are another form of short-term investment, and then inflation. So for the long term, yeah. In fact, there's a very good book called Stocks for the Long Term. In the intermediate term, or even the short term, or even the intermediate term, we may be disappointed and crying in our beer. But as long as we keep a long-term perspective and don't panic, we've been well rewarded. Is it a guarantee for the future? No. And then again, let's take a look at this graph that shows a 200-year history that shows that this has been the greatest expansion of the global economy in the history of the world. Our standard of living is so great that we just take it for granted. But a king or queen from the 18th century, in all their splendor, would, if they were plopped down into the modern world, would gawk like a peasant to see what kind of luxuries we enjoy in the modern world. And we talked about gold, right? We'll talk about it later on. Gold's not a very good investment. You want to buy gold? Buy gold. But where are you going to keep it? Later. Where do we want to be for the long term? Stocks. But what do we know? We're going to have to learn to deal with times when stocks don't return their historical norm. And so let's break it down into rolling 10-year periods. This is the Dow Jones Industrial Average, and we'll discuss that in detail later on, but it's a very popular measure of how the market is doing. It's not a very good one, but it's a popular one. And if you go back to the Great Depression, you see rolling 10-year periods. You put $1,000 in, 10 years later, did you have more or less? Well, you had less, 3 years in a row. But then we come, and what did you hear people say? Oh, is it too late to get? Yeah, it's too late to get out. Yeah, now's the time to put it in. Because here we come out of World War II, out of the Great Depression, and stocks moved in two directions, up and way up. And they returned over 10-year periods almost 20%. And what did you hear people say? Ooh, is it too late to get in? Yeah, it's too late to get in, because here comes Vietnam War and the civil rights marches and women's rights and gay rights and Watergate and the first oil crisis and the second oil crisis and inflation and disco. You didn't live through it, folks. It was a tough time. And you have to go back to we don't quite hit a 10-year period where you lose money, but it's pretty darn close, right? Just barely made a buck in those 10 years. And what did you hear people say? Is it too late to get out? And sure enough, we come out of the 1970s and vanquished inflation and vanquished disco. and we have globalization and new technologies and computers and this crazy thing called the internet and telecommunications, and stocks went in two directions, up and way up, and you had almost 20% returns. And what did you hear people say? Ooh, 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 is it too late to get in? Yeah, we had the first in the 2000s, the internet bubble bursting and being replaced by the housing bubble, and then that bubble bursting. And in 2008, you had to go back to the Great Depression to see rolling 10-year periods where you lost money. And you know what I'm going to say. What did people say? Oh, is it too late to get out? Yeah, right. It's too late to get out. And so we're coming back now. Does this mean we're going to repeat the exact same cycle as we did before? I don't know. I don't actually think so, but that doesn't mean I'm right. It doesn't mean I'm wrong. Either way, as long as we've seen, as long as we have a 10-year period, a long-term perspective, as long as we have a long-term perspective, we've done pretty darn well. And if the world does end, if technologically based civilization cracks, falls, and dissolves into a pool of tears, and then all bets are off, right? Doesn't matter where you put your money. If there's no food at the grocery store, no gas at the gas station, there's no clothes, the cell phones aren't working, the utilities not pumping out electricity or gas, the hospitals, the schools, the banks, the fire departments, the police departments are all shuttered, the trash isn't being picked up, the sewage. You know what? It doesn't really matter where your money is, does it? Failure is not an option. And I am firmly convinced. I'm old too. Usually people get old, they get bitter, right? I'm firmly convinced that the next 30, 40 years or 20, 30 years or so are going to be the most prosperous years in the history of the world. Better than they've been. If we don't blow ourselves up, die in our own waste, another pandemic or two, a tsunami, earthquake, floods, catastrophes, fires, disco returns. I'm positive. I'm very optimistic about the future. We'll see. We humans are very adaptable. We have to be to survive, and we'll see how long we survive. I be optimistic. Remember, be ye joyful, even after you've considered all the facts. Slide number 7. Traditionally, close to half of the return from stocks was from reinvested dividends. You see, stockholders used to expect 4, 5, 6% in dividends each year. This was as much or often more than bonds were returning in interest, because stocks were considered much riskier than bonds. So if we go back between 1936 and 2008, we see that the S&P 500 dividend average, and we'll discuss the Standard & Poor's 500 in detail in a future presentation in this chapter, was almost 4%, 3.8%, which is not bad, right? But dividends fell to less than 2% or even 0%. So in the 1980s and 1990s, people said, I don't want dividends, give me capital gains. So if you go between 1997 and 2007, the dividend averaged only 1.5%. And as we said, people, they just said they wanted the business to reinvest their earnings for growth instead of distributing it to the investors. Dividends were taxed at a higher rate. Well, that's not true anymore. Stocks were no longer considered riskier than bonds. Well, I hope people realize that they are riskier than bonds. Savings accounts are not paying very much. Wait till you find. Well, hopefully you've done the chapter 1 assignment. People lost track of their senses and bid up the price. Well, that's certainly true too, right? Internet bubble, housing bubble, and now we've got bubbles lying all over the places, depending on who you talk to. So let's take a look at that dividend yield. That's the bottom chart here in, I guess, a burgundy or burnt red or something like that. And then the blue, pale blue, is the yield on bonds. What bonds are paying in interest versus what the stocks were paying in dividends. And going back to 1960, you see it was fairly close to one another. Bonds were paying a little bit more, but stocks were paying almost 4%. And then we start to see inflation raising its ugly head, yeah. And so interest earning bondholders said, we want higher interest because interest is coming along. Inflation has come along. We want more interest. And we got hit with a vicious bear market in 73 and 74, which made the dividends spike upward because the price went down, so the dividend yield goes up. We'll discuss that calculation in this chapter. So we saw the yield on stocks go up, nowhere near as much as the yield on bonds. And then in the late 1970s, early 1980s, the government decided we got to do something about this. And we had a president by the name of Jimmy Carter. Yes, young folks, there was a president named Jimmy. And he went to the Federal Reserve Bank. The chairman was Paul Volcker, who every once in a while they trot him out. He's still around, and he's a very bright man. And the president said, what are you going to do about this? We got to do something about this. And Paul Volcker said, well, we can, sir, but it'll cause a very vicious recession. If we do, we're going to raise short-term interest rates and break the back of inflation. And it might cost you your election in 1980. And to his credit, Mr. Carter said, that's okay, you do what you need to do. So they the Federal Reserve Bank drove short-term interest rates up to, I think, 22%, I think is when it just, oh my goodness, it's just very, very onerous. It broke the back of inflation, but it also caused the worst recession since the Great Depression. And sure enough, interest rates started coming down. And what the next Federal Reserve Chairman, Alan Greenspan, called the Great Moderation. And we saw the yield on stocks coming down. Why? Because the prices are going up and people wanted more capital gains. Until finally in 2000, we hit the low point on stock dividends of 1%. Notice that the yield on bonds kept falling. And then the yield on stocks rose in 2008. Why? Because the price went down. And we saw the yield on bonds go below the yield on stocks. Now, when this happens, it's usually, but not always, a sign that things are not too good, but it's one of the best times to invest. You invest when there's blood in the streets. That's an old saying. Goes back to the time of the Napoleonic Wars. And sure enough, that was a great time to invest in stocks. And the bond yield went above stocks, and then the bond yield went below stocks. Another great time right before 2013. And we've been bouncing along. And now what's happened is that they're both pretty low. So you'll hear people say, we have the mother of all bubbles. Stocks are going to get hammered. Bonds are going to get hammered. Just you wait and see. Well, we know someday it's going to happen. We don't know when. How bad it's going to be, we don't know that either. But we do know that if the world doesn't end, and we have a long-term perspective, and we don't panic when the markets fall, because they will, we should do well. But no guarantees. Slide number 9. The pendulum swings. The bear markets of 2000 to 2002 and 2008 have changed investors' perceptions about dividends. We now see investors and companies focusing more and more attention on dividends. Many companies that never paid dividends in the past are doing so now. It was, I think, 2003 when Microsoft finally decided, okay, we'll make a... They had $60 billion in cash or $70 billion in cash coming out of their ears. And they didn't know what to do with it. How many more times can they rewrite Word and expel, and they never get it right. They don't want to get it right. That means they have to stop doing it. They always want to keep it, making the better one. I'm sorry, I have a pathological hatred for Microsoft. But the same thing is true with Apple and Google and these other companies that are now sitting on tons of cash. They said, okay, it's time to start paying our shareholders dividends. So now there's some of the great examples of companies that are raising their dividends. And the tax laws have changed so that dividends are taxed roughly the same as capital gains, which means the rich people get better tax treatment than you and I, than you and me, who work for a living. But that's okay. That's part of capitalism, I guess. It depends on who you elect. Um, there's a great saying. Now it's a book too, and the book says it's not that great. Geraldine Weiss. She was based in La Jolla. I don't know where she is now, but she wrote a book called "Dividends Don't Lie." The book, but the name of the book is fabulous because it's absolutely true. All the numbers that we look up on the internet, we look up and go to the library, whatever, that the company reports, they could be all fabrications, and sometimes they are. Enron, WorldCom, Global Crossing. But the one number that we know is not a lie is dividends. Why? Because they wrote us a check. Well, they don't write a check anymore. It's all electronic. But still, dividends don't lie. And this next quote is attributed to John Rockefeller. You've heard of the Rockefellers. We don't really know if he said it or not because his neighbor said he said it, so we don't know. But it's still it's a great line. Do you know the only thing that gives me pleasure? It's to see my dividends coming in. I like dividends. I'm a big dividend fan. I like capital gains too. Slide 10. Let's quickly dispense with this idea of bull markets and bear markets, and those of you who are interested in the etymology of words. We use the term bull market when the market's going up. Yippee, everybody's really happy. Favorable markets normally associated with rising prices, investor optimism, economic recovery, and government stimulus. We use the term bear market for times when the market is falling, specifically if it drops 20%. Now, in 2018, it dropped 20%, but because it didn't end the day at 20% lower, it wasn't an official bear market, but it still was a bear market. Unfavorable markets normally associated with falling prices, investor pessimism, economic slowdown, and government restraint. Now, where did the terms come from? Well, most people will tell you that bulls charge ahead. They throw their opponents up in the air, right? So rising. Bears are more reclusive, and when they do attack, they paw down at the... I don't think it's the real terms where they come from. If you really want to, you could research it. It has something to do, bear market has something to do with bearskin jobbers. And I've read it several times and I still don't really understand it, but maybe you would be interested in that, especially if you're a word hound. Speaking of animal metaphors. Slide number 11. So let's review. What are the pros and cons of stock ownership? Well, the advantages is that it allows the general public to share in the rewards of business enterprises. You see FedEx driving around and UPS, and you see Nike doing well, and you see Apple, everybody buys Apple products. You can join in. You can join in the business enterprise. They've been the best financial investment returns over time from dividends and capital gains. And remember, the real estate agents jump up and down when we say that stocks have done better than real estate, but we'll discuss real estate later on. They're easy to buy and sell. They're very liquid, assuming you've purchased high-quality companies. And we talked about the limited liability and the increased standard of living for everyone. You know, capitalism might be the absolute worst system ever developed, except for all the others. Yeah. How's it working for you out there, Venezuela? Not so good. And then what are the cons? Well, the major problem with stocks is the volatility, the risk. Although there's every once in a while, corporate hanky-panky accounting gimmickry and the like. But that happens, but the real problem is the risk, and we have to remain calm when everyone else believes the world is going to end. Because volatility, we told you, is that popular euphemism for losing money. How's that stock doing for you? Well, it's been very volatile. He sold it for $10. I bought it for $10, and now it's selling for $3.50. So we have to be able to live through that, right? And we have to then reevaluate the stock and say, well, would we buy it at $3.50? If no, and then it's probably time to sell and take our loss. But maybe not. Maybe we should buy more. It's a lot less than what it was. Now I get it on sale. It's part of the decision-making process we're going to make. But the volatility is real, as one student said, and I can never forget. And here is volatility examined. Here's the Standard & Poor's 500 for the year 2020. So we all know that 2020 is a year we'd all like to forget for various reasons, not the least of which is the pandemic. It started off not so bad. You put in $10,000 and it kind of bounced around and actually went up a little bit. And then COVID hit and it just fell faster than it had ever fallen before. We had a bear market, 20% decline, faster than it had ever done before. But it also recovered faster than it's ever done before because people realized, this thing is really horrible and a lot of people are going to die, but we're not going to lose civilization. Yeah, in fact, some companies did really, really well. Other companies destroyed, the leisure, the restaurants and the cruise ship companies, they got destroyed. Whereas some technology companies, how many people had used Zoom? Well, we used Zoom before this, but most people never even heard of Zoom, but now it's a household word. So we talked about it's probably not true, but the symbol for crisis in Chinese language is supposed to be a mixture of danger and opportunity. But what did you hear people say here? Oh, is it too late to get out? Yeah, because then you saw the market just go in two direct. Well, it bumped a little bit here at the end of this is right before and right after the election, or right before the election, but it ended up pretty smartly. So if you had gone to sleep, put your $10,000 or $1,000 or whatever into the market on January 1st, 2020, and then came back on January 1st, 2021, you actually did pretty darn well. You just missed all the turmoil, which is probably not for the best. Maybe, which is probably for the best. I mean, probably better than living through that toilet paper hoarding and I make light of it. I apologize. I shouldn't, because a lot of people have died and people are still dying. That's sad. Cool. Okay, so go back over, make sure you understand what are stocks, what are the advantages, what are the disadvantages, and what can we reasonably expect from our investments in stocks over the long term. Cool, because when we come back, we will now take a look at the stock market, which is not just one place, folks, one thing. It's a lot of different things. See ya! Oh, we're so excited, by the way. We're so excited and so proud of you for being in our class. And we thank you. And we hope you're getting an education. We certainly hope so. And you're reading the book, right? Very, very cool. See you in our next presentation.